About 4 years ago, I got added into a Telegram group chat, and it was for Steve Marrow's mentorship. It had hundreds and hundreds of videos, and the whole story was that apparently this guy, Steve Marrow, was on a flight somewhere years ago, like we're talking like over 20 years ago, on a flight somewhere, and he was sat beside a market maker. And the market maker told him these set of EMAs and timings on which he should base his strategy on, his trading strategy. And God knows if that's true. No idea if that's just complete shite or what. But the EMAs and the levels that they talk about in that are absolutely golden. And it's the same as every other market maker model, market maker levels that we'll have heard of. At the time, I started using it. We're talking literally 5 years ago now. Started using it, and this is my first 2 years of trading. And my direction, my bias and my bias and my direction was so on point. It was crazy. I wasn't making any money at all. Like I'd do my weekly forecast, predict where the market was going to go, but then just never participate or just completely mismanage it every fucking time. So I couldn't actually trade properly because I didn't have proper risk management, etc. But my direction was always on point. I put this down to strategy issue. Let me learn ICT. Let me go on fucking try and figure out the market. Let me learn supply and demand, etc. Now, 5 years later, I've gone fully round the block, completed the full circle. And what actually made me profitable was reducing it back down to basics. I was going to say most traders are not profitable because their system isn't mechanical enough. My trading wasn't profitable because it wasn't mechanical enough. I had the mechanics, but I wasn't executing the same thing repeatedly over and over again. As soon as I simplified my rules and I had the risk management, the proper process, that's when I saw profitability. My risk reward wasn't so good in the beginning, but I was consistently making withdrawals. And then since then, I've optimized it so to improve the RR, just dancing between RR and win rate. But it's pretty dialed in right now. So I'm really super happy with it. The main thing that got me profitable was the simplification. The market maker levels are what make it simple. Having something where we can just look at it and mechanically say, this is what I'm looking at, yes or no, that is what made the difference for me. So I'm going to do my best to break it down, turn it inside out. I prepared a whole bunch of stuff to really double, triple click on this and nail this so that you watching this will be able to actually take these levels and use them in your trading now. Okay, let's get stuck into it. So the market maker levels. So the levels are basically the repeating cycles. They're engineered by market makers. So they're using psychology and algorithms to make these moves. It's repeatable. So again, the market maker, they don't have it. They're not coming to the screen with their objective of, let's say, offloading euro to dollar and trying to figure out how to do it. There's a tried and tested way. There's a set way that they can actually shift this amount of money without, or basically getting the best price for them. And it's repeatable because, again, if it ain't broke, don't fix it. This is the way that they've been doing it for years. It's repeatable. We can identify it. And once we learn the characteristics for each move, it just makes our trading so much easier. Again, it simplifies everything. So each level has a objective. Level 1 is to trap the volume, get the fuck out of there, put traders underwater, and basically initiate the reversal. So it establishes the move. Level 2 then, trade both ways. So it's typically a larger consolidation. And in this, its purpose or its objective is to confuse traders. It's to get liquidity into the market ready for the last expansion. Then level 3, the last blow off, its objective is to suck in buyers or sellers in the wrong direction and then trap the volume for the reversal. So, oopsie daisies. And then after three pushes, the cycle will reset. And again, that's where people are getting caught buying high or selling down low. So the market's fractal, as we know. Same thing applies with the levels. So a full cycle, level 1, level 2, level 3 on the 15-minute will just be level 1 on the 1 hour. Same thing applies on the 1 hour. Level 1, level 2, level 3 on the 1 hour will just be one cycle or one level on the 4 hour. So each level is an accumulation. So it's literally a consolidation. And we'll go through the different ways that we can actually identify the levels in a bit. So here we can see again, exact same way as market structure. So we have highs and lows, but it's actually just one swing high in the hourly compared to a full cycle here, just one move on the 4 hour. Fractal nature. So you've probably seen this here before. If you've studied any kind of ICT or any market maker theories. Week begins and we have, let's say, beginning consolidation, false move. This can be the ICT Judas swing. Most traders are breakout traders, and most breakouts fail. So we pierce up above, and then here we can see this push down. So this might be Monday, Tuesday, Wednesday, Thursday, Friday. Or Monday goes down, Tuesday, Wednesday, Thursday, and then Friday pulls back in consolidation. It can be any variation of this, but in this whole thing, we are seeing multiple cycles. So for instance, here, this is a full 15-minute cycle down, let's say. So we have level 1, level 2, level 3. This then could be a full 1 hour cycle up. So level 1, level 2, level 3. And then a reversal, level 1, level 2, level 3. So we're going to go through it on the charts, but just know that every move that we're used to identifying on the charts, we can actually slot the levels into that. And adding that extra lens really helps us to know where we are in the market and to know what to anticipate next. So we won't go through the moving averages yet. I'm going to jump into Miro, and we can just go through the different ways that the levels are actually identified. So levels, like we said, each level is an accumulation. And again, it's just going push up, push up, push up, 3 pushes up. We can observe it via actual pushes. So price actually just having an impulse move. We can count it via numbers boxes. So literally 50 pips, 50 pips, 50 pips. And again, we've got examples of all of this coming up. We can view the levels via days. So 3 days. So day 1, day 2, day 3. 3 sessions, session 1, session 2, session 3. Or 3 consolidations. Consolidation 1, consolidation 2, a little bit higher, and then consolidation 3. So anything where we can count 3 blanks of rise or fall is a level. So again, then level 1. So again, this is the theory. We're going to go through the visuals in a second, but we really want to nail the logic behind it. So level 1 is where the move begins. So let's say we've been trending down, we've been in a downtrend. At what point do we actually switch to an uptrend? That switch is typically violent, and it moves fast and quick. And basically because it's the false move. They're sending traders short to then reverse. So it doesn't come back. That's the logic behind level 1. You do not want to counter trend when you've identified we're in level 1. Objective, switch the books, trap volume. Level 2 then, they've done their dirty work. They've trapped the volume. That's the reversal confirmed. They'll then send price up, down in a large consolidation. Objective, to get liquidity in both sides to have the next move, and also to confuse traders. So we've had a big move up from level 1, big push up. Now we're thinking, okay, which way is this going to go? Was that just a pump to then get dumped into, or is this a reversal? And then level 3, typically, put it here, 1 push, 2 push, 1, 2, 3. Level 2 is a big consolidation, and level 3 will blow off outside of that. 1 push, 2 push, and then 1, 2, 3. This 1, 2, 3 can be 3 pushes up. It can be 3 peaks. It can be a head and shoulders, like 1, 2, 3. Anywhere where we can identify 3 coming out of a consolidation. And again, the objective of this is to get the traders in. FOMO, fast movement, violent movement, blow off again in the direction of the trend before trapping volume. So that's the logic behind the levels. Now I'll go and show you each of those here. So here we can see, just for future's sake, all of these here. So this is double zeros. This is a 25. This is 50, 75, 100. So we can actually count the levels based off of those numbers boxes. So basically, long story short, from here to here is 100 pips. Here's a halfway point to the 50 mark. So once we have our levels identified, let's say we're on level 3, what we'll typically do on level 3 is we will pierce outside. So we will, again, talking about level 3, it's a blow off in the direction of the trend. So here, you can see price blows off and it pulls back inside. this will typically happen 25 to 50 points above round numbers. So above these double zeros here. If you don't want to use if you don't want to use the numbers, it's completely fine. It can just add a layer of complexity. Then you can just imagine the stop hunt's going to happen 25 to 50 points outside of that last consolidation up there. So here's why we use the numbers. And again, they're not necessary at all, but sometimes it can be very clear from looking at them what level we're on. So we can see here, here's the stop hunt outside the range, 25 to 50 points. This is level 3 on the short side. Level 1, all in behavior, get the fuck out of there, trapping the volume. They do not need to return to there because everyone who's been selling is now underwater. Then, here we're looking at it from a numbers perspective. So we can see 100 points, 100 pips, 100 pips. So that's 3 levels of 100 pips rise. 1, 2, 3. Level 3, and then level 1, all in behavior. Get the fuck out of there. They've trapped the volume. They do not need to come back there. Here we can see it in days. So we can see day 1, day 2 up, day 3 up. And we can also count it via numbers. So from here to here is 25 pips. So we have 25, 25, 25. And then what do we have at the top? Stop hunt, which is 25 pips outside of the range before reversing. Level 1, all in behavior. Get the fuck out of there. They've trapped the volume above here. They do not need to return to this space here. Here we have it in days as well. So we see day 1 up, day 2 up, and day 3 up. And guys, the important thing is that they take out a previous day's high. So you can see here, this is a down day, but we took out the previous day's high 3 days in a row. That's a golden sign for counting the levels. So we'll go through again more day count examples, but again, we can see from orange line to orange line is 50 pips. So 50, 50, 50, and then the stop hunt trap volume is 25 points outside of that range again. Here then on gold, 250, 250, 250. You start to get the picture that you could just, it doesn't matter what the number is. Gold indices will have bigger ranges. Some currency pairs will only move 25, 25, 25. Pound pairs can move 50, 50, 50. It's just about being able to identify anywhere where we can count 3. So we can see we're in this 100 pip range, sorry, this 250 pip range. Then we push up into this one, and then we push up into that one. Then we can count it by the pushes. So we can see first push, second push, third push. So again, this is a fractal. So this is a zoomed in one. This is literally Asia session. This is London session. So in the gap time, we had a full cycle. Level 1, all in behavior. Get the fuck out of there. Trapping all this volume here. So you have the false break here, send price down, trap the volume, and then level 1, blow off, reversal. Level 2, trade both ways. So level 2, confuse traders. Is this going up? Is this going down? Level 3, blow off in the direction of the trend with a 1 push, 2 push, 1, 2, 3. So 1 push, 2 push, and then a 1, 2, 3 to the high. Then we can count as well the 3 peaks. 1, 2, 3. Here's a false break above there. And then the reversal, level 1, all in behavior, back down. Then a more simple way to, or an easier to conceptualize way is just in pushes. So 1 push, 2 push, 3 pushes. And again, guys, the whole reason that we're doing this, the reason that we're walking through this is that we're able to identify when there is a reversal. So if we can count the levels, we know we're on level 3, we can then anticipate when the level 1 is going to be and then trade from there. So here's a bit more messy one. So 1 push, 2 push, 3 pushes. Very clearly able to see 1 push, 2 push, 3 pushes. And again, the stop hunt is 25 points outside of the range. Here's a fractal version again, zoomed in. So level 1, we can see all in behavior. Level 2, trade both ways. And then level 3, 3 peaks. So a blow off in the direction of the trend. Here we can see it 1, 2, 3 peaks at the top, and then we reverse. Example here, 50, 50, 50. And then here, variation. So we have level 1, all in behavior, level 2, trade both ways, and level 3, the peaks at the top. And then again, we can also identify them not only by the pushes, so here's the first push, second push, third push, also by the consolidations. So here we have the first consolidation, second consolidation, third consolidation. Then in terms of the consolidations, level 1 is typically smaller. So it will generate some liquidity, but they're in the process of getting the fuck out of there, remember. So they don't need to come the whole way down here. That's why it'll typically have a smaller range. Level 2, typically larger range, so big ups and downs, confusing traders, getting liquidity in both sides. And level 3, power of 3, it'll be 3 something, 3 pushes, 3 hits, 3 peaks. And then it can be an extended consolidation before trapping the volume. It doesn't have to be. Level 3, in order to qualify for level 3, we just have to have a closure outside of level 2's consolidation. So here's some variation. So we can see level 1 consolidation, level 2, level 3, and also day 1, day 2, day 3. Day 1, day 2, day 3. Level 1, level 2, level 3. So here's that variation where level 3 doesn't have to be the whole way up here. It can be. Level 3 can blow off like 1 push, 2 push, 1, 2, 3. And the consolidation could be up here. But no, here it's just above. We have closures above level 2's consolidation. Therefore, it's valid. We can count the levels via sessions as well. So 3 sessions in one direction. So we can see Asia down, London down, New York down. That's 3 cycles down. Here we can see 50 pips, 50 pips, 50 pips. Day 1, day 2, day 3. And then on day 3, we have Asia up, London up, New York up. We're stacking layers on top of each other, stacking levels. So we have days, we have pips, and we have sessions all in one. That's level 3 on multiple, I was going to say dimensions, but multiple level 3 stacked on top of each other. So just again, increasing the probability that we actually are on level 3. So then the day count, I'm not going to dive too deep into the day count, but again here we can just go over this. So level 1, we can hop back onto the presentation actually. So actually no, better to stick on the mirror. So level 1, the objective again, it's to trap traders in the wrong direction. So we've just finished a full cycle going up. We're now going to be reversing. So when it reverses fast and hard, and it does not come back. So fast and hard, price doesn't revisit that area. Here, fast and hard, we do not come back down here. Imagine you're drawing a rectangle the whole way across here. All these people here are now underwater. There's no need for the market makers to come back down there and let those guys out. So its characteristics, typically aggressive, fast movement. Do not countertrend that. And typically it will be an expansion of the range created in level 3. So for instance here, from this low to this high, we could extend that up, and that will typically be the expansion that level 1 gets. Here, level 1, level 2. So level 1, all in behavior. Level 2, trade both ways. And level 3, blow off in the direction of the trend. 1 push, 2 push, and then a 1, 2, 3 to the high. 3 hits. We can see 3 pins there. Just trying to look for anywhere where we can count 3. You can clearly see 3 pins to the top. And then we break structure on the inside. Level 2 then, objective is to confuse traders. So to generate liquidity and confuse traders. So is this going up? Is it going down? We can get a break of structure to the downside here, thinking it's going short, pulls back up, and then we coil. So trade both ways, try to get less pips. Again, level 1 and level 3 can be the more explosive moves. Level 2, you can take shorts, you can take buys. Again, it's just easier to stay in line with the trend. Level 3 then, the objective is to blow off, suck in everybody, the last few stranglers, and then reverse and trap those guys, leave them underwater. So they blow off. And this, again, as we said, it can be held for multiple days, or it can just be a small consolidation at the very top. Again, its characteristics is typically fast movement as well. This will have fast movement down into the low, quick movement. It'll go sideways for a bit and then send price down violently fast. Okay, that we don't need to cover now. Definitely none of that now. Okay, yeah. So, and then the last way, which we're going to go over identifying the levels, is actually via the EMAs. So we have our pushes, so we can see 1 push, 2 push, 3 pushes. We have our consolidations, consolidation 1, 2, 3. Day 1, day 2, day 3, session 1, session 2, session 3, 50 pips, 50 pips, 50 pips. The last way that we're going to cover is actually what I learned in Steve Marrow's mentorship. So it's basically using the combination of certain EMAs, the 13, the 50, the 200, and the 800. I'll pull them up on my chart now in a second, and you can take a screenshot. But it's basically just a way of actually mapping out where we are in the cycle. So we identify it via the EMA crosses and their position in relation to one another. And it's very simple. It's mechanical. And once you nail it, it is just something you can instantaneously look at a chart and see, okay, we're on level 1, we're on level 2. This is clear level 3 behavior, let's say. And it's also identified by, or the cycle will be finished by identifying RSI divergence. So a divergence between what's actually happening on a chart and the relative strength index. So the indicator cycle then. The indicator cycle initiates with a 13 and a 50 cross. So I'm going to just pull up my chart just so you can take a screenshot of the indicators now. So the indicator is 5 EMAs. Oopsie daisies. The indicator is here. Where are my indicators? There we go. 5 EMAs plus crossing alerts, and it's by Chris K. And then here's my inputs. So the 13, 50, 200, 800, screenshot that. You don't need to use the 55, just untick it. So I just use the first 4, 13, 50, 200, 800. Red, blue. If your chart is light, you can just change this to a green. If it's dark, keep it white. And this one, purple. Then when they're mapped out, we can see 1350 cross. That means level 1. 50, 200 cross, that signifies level 2. And then the EMA is actually fanning out, so spreading out, going from being like this to like this, spreading out. That's a sign of level 3. And then what we're doing once they've done that, we're waiting for them to crisscross, and then the 13 and the 50 to cross back in the opposite direction, signifying level 1 short. And again, then at the top and the bottom, we will be able to identify RSI divergence, which I'll cover in a second now. So we've gone over level 1, level 2, level 3. That's one cycle finished. What we'll typically get after that is then a reversal, and then we'll get level 1, level 2, level 3 short. The other variation is when we get a reset. We get level 1 up, level 2, level 3. If price isn't done going up yet, we'll just get a reset, and then we'll get another full cycle up. So another level 1, level 2, level 3 up. We can keep doing this until we get the RSI divergence at the top on the hourly. So we've covered this already. Level 1, all-in behavior, 1350 cross. Get the fuck out of there. You can see on level 1, it's always that does not come back type behavior. Level 2, then once the 50 and the 200 cross. There we go. And the reason that we're identifying all of this, and the reason that the EMAs are so useful, is we can actually take trades off of the EMAs. So the EMAs act as dynamic support resistance. So support resistance that moves with us. So we'll have our static support resistance here. The EMAs will actually be that dynamic moving area that we can actually take trades from. And level 3, the EMAs all spread out, and then we'll consolidate, and then we wait for the 1350 cross back in the opposite direction. Okay, we don't need to look at that now. Cool, so now we're going to go through and actually draw some levels live so we can see. So what I'm looking for when I come to the screen is I'm like, okay, let's go back a little bit, and what I want to see is where can I identify a cycle beginning. And the important thing with levels, guys, is not trying to fit absolutely everything into the levels. It's waiting until everything is clear. So, for instance, sometimes it won't be clear what level we're on. For instance, you might look at this and think, okay, well, where is the EMA cycle? This will typically be one level on the 4 hour. So this is just an extended level 3. I'm looking at this and I'm immediately seeing, a second, I need to move this over. There we go. So what I'm seeing is this is a level 3. We then come down for a level 1 short and then have a level 1 long again. That's a little bit complicated. Basically, you can just view all of that as one 4 hour level. But let's not start with complicated stuff. Let's actually start with something we can clearly identify. So here, immediately we can just see, okay, this is level 1 behavior. Why? It's all in behavior. Price comes down. We have a false break, consolidation. So level 3, typically a consolidation, and then all in behavior. That to me is like, okay, perfect. That is level 1. So then we see this, follow it up. That's level 1. Then next consolidation, level 2. And then we get another push up and we're in level 3. So now we're at level 3, we're looking at the stop hunt, which is typically 25 to 50 points outside the range. And then we have a reset here. So one thing to know, remember we mentioned that one full cycle on the hourly would be one push up on the 4 hour. So this is the 4 hour cycle is trending up. So therefore we'll get multiple 1 hour cycles to the upside. When we get a reset, what will typically happen is we'll get a level short, level 1 short, followed by a level 1 long. So that's the way that they reset it. They'll do one level short, suck in the traders, and then reverse with continuing the trend. Then level 2, and then level 3. So again, I'm just looking at where we get into pushes, 1 push, 2 push, and then 1 push, 2 push, 1, 2, 3. Level 3. And you can see here again, this behavior here, they send price down, and then they pull it back up again. So this is then one level down on the hourly, followed by one level back up. And what we can actually see is a fractal nature. So here we can see this is actually a full cycle down on the 15-minute. Level 1, level 2, level 3. And then what do we get? Level 1, all in behavior, boom. Which is actually a trade I took, buying euro. So we can keep going. Again, what I'm looking for is identifying when the EMAs are initially crossing over, and ideally if we have a false break around there. So here, make that yellow so we can see it. There we go. So this was our existing high. Oopsie daisies. This was our high point, and then we have a false break. That to me is exactly what we want to see initially. We want to have a area and then price to break above it and then false break. Then the 13 and 50 cross. So it's like, okay, game on, start counting our levels. So we can see our first consolidation here. Next consolidation here. And then our third consolidation here. So this whole thing is our third consolidation. And we can identify by pushes as well. 1 push down, 2 push down, 3 pushes down. So then we reset, and then we have level 1 short, level 2 short, and then remember level 3, it just has to be a consolidation outside of level 2. So we have a small level 3 down here, and this is a reversal, etc. So this would be a full 15-minute cycle. As we can see, this is not an hourly cycle. We can see level 1, level 2, and then level 3. This one could even then be a 5-minute cycle. Let's see, you can see a really small consolidation here. Level 1, typically a small consolidation, tighter range. Level 2, typically trade both ways, confuse traders. There we go, level 2 consolidation. And then variation of level 3 consolidation the whole way down. And we can see it again, This is a smaller time frame consolidation. Sorry, cycle. Level 1, level 2, level 3. And then remember what we mentioned, like above, when they're doing this, putting in the peak, you typically have one level down, one level up. So you'll have like this M structure being created like we saw here. We saw back here. The M structure. Ooh, there's a micro one there, and here as well. So this M structure being created. So guys, the levels are forming everywhere. They are, you might be thinking, okay, well, how are you looking at these? It will become second nature, and the way that you do it is just literally repeatedly over and over again. Keep drawing them, keep drawing them, keep drawing them. And always be aware that if you can't clearly see the level, you might just have to change time frame. For instance, here, you're thinking, okay, what the fuck is this? This is just a 15-minute cycle. You just have to drop down to a different time frame and start marking it out. So you can see the level 1, level 2, and level 3. And it looks different because it's on, we're on the hourly, looking at a 15-minute cycle. If you do drop down to the 15-minute, you'll be able to see the same shapes occurring. So I would encourage you to start drawing the levels. If you have any questions, which I'm sure you do, this was there's a lot to cover there. There's a general synopsis of the levels. But basically in the next one, when I'm talking about levels, I'll go through how we can actually use this to trade. And it's what we call safety trades. So it's literally buying, once we know what cycle we're in, once we're in an uptrend, we're then just buying the dips back down to the EMAs, if that happens in our timing window. So yeah, I'll cover that one in the next levels video. Guys, have a good one. Yeah, again, drop any questions below. I'll get back to anyone because I'm sure, yeah, there was a lot to digest here. Peace.